Hi, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about caps and participation rates in annuity contracts and which of them work better in a huge bull market and then which one would be better in a bear market. Okay, there are different strategies that you need to consider. So again, I sell annuities. That's a disclaimer. I like to share it because that's how I make my money. And if you're looking to purchase an annuity, I'd love to help you. Okay. But I'm not going to try to push you or sell you. A lot of guys do that because they want to make a commission. For me, I just want you to see everything that's available and then you can make the best decision for yourself. Okay. So this video is meant to be helpful and I'm going to be sharing my screen. I'm going to be sharing a lot of good information. It'll help you in your annuity search. And if you're working with someone else, it'll still help you. Okay. But if you are looking for someone who's transparent, who shows everything, regardless of what he's getting paid, then I would invite you to book a call with me. There is a link below this video. It goes directly to my calendar and it will be a Zoom meeting. And you can also go to my website, johnstevenson.com, and you can book a Zoom meeting with me right there. And you can also see all of the annuity payouts. Okay. You can see all of the income payouts. If you're looking for fixed rate contracts, the MIGAs are great for that as well. But for today's video, we're talking about caps and participation rates in an indexed annuity, and you will not find that on my website because there are like 4,000 options, okay? And they change all the time, and I cannot update those on my site. So I apologize for that in advance. You'll have to book a call with me, but hopefully this video will help you. And if you do want to book a call, don't worry. I'm not going to try to sell you anything, okay? I hate being sold. I'm just going to show you, here's what this does, here's what this does, here's the caps, par rates. I'll show you what I would recommend, okay? And then I'll send you the PDFs, and then you can decide what you want to do. I'm not going to even reach out to you after that because I like educating people. I like showing them what's available, and then the annuity product really sells itself. And you really shouldn't be pushed into something like that. You should give really as much time as possible for your research. So, all right, I'm going to share my video. This is someone in New Mexico. They're 60 years old. They got $250,000, and they reached out to me, and they're like, okay, which index should I do? Which company? I see all these participation rates, 175%, 190. Wow, that looks really good. But look, there's some fees. It's just a lot of options. And they're like, there's so many to choose from. So many to choose from, right? And there are. But there's only a few that I would recommend. So if I were looking at all options, I'll just kind of go down here, show you. There's 4,700, okay, on this page. So there's a lot of different variations, a lot of different indexes, there's different carriers, and you might be pitched something that gives you like 80% participation rate in the S&P index. Participation means how much you get to participate, okay? If the index does 10% and you get 80% participation, you're going to get 8%, right? But if you have a cap of 10%, right? Well, you're going to get the full 10%, right? That can be good. But what if the stock market does 30%, which in good years it can? Well, you're capped at 10. You're not going to be very happy with that cap. But if you had a participation rate of 50%, boy, you'd be happy with that because you get 15% growth that year, right? That is why, in my opinion, participation rates are the best for a bull market. But if the market is kind of sideways, maybe it's not doing so good, and you don't really have a good outlook, you're thinking, well, we're going to have a correction territory for the next 10 years. We might have a few okay years that's making like 10 or 12%, but most of the time it's not going to be that great. It's going to be kind of boring, okay? Well, in that case, a cap would be better, right? Because you don't want 50% of 12%. That's only 6, right? You're only going to get 6%. But if you're getting a 10% cap on that, that's pretty good. You know, you're getting most of the index, okay? But you know, it's hard to tell. People think, well, I don't know if it's going to be a bull market or a bear market. Well, you can always mix it up. In the same annuity contract, you can put part of it in a participation and part of it in a cap. But in my opinion, I'm very bullish on the market. Even if we have a couple years where it really goes down hard, I'm still very bullish on our country, on our economy. And so for me personally, I like the participation rates and I see people making the most money over the long term with those. But I'm going to compare and you can be the judge. Okay. But one other thing you need to realize when you look at participation, you're looking at caps, you need to also pick a company, a carrier that has a reputation of having high renewal rates. Okay. What do I mean by that? I mean, if they give you an 80% and they lower it to 30% next year, because every year they change those par rates and those cap rates because they're buying call options. Okay. And those call option prices change every year. And sometimes they become very expensive and they're going to lower it quite a bit. Or sometimes they don't become expensive, but they still want to make a ton of money and they already got your money locked up. So why not, right? They'll lower the cap and the par rate on you and there's nothing you can do about it. So that's why when I look at these companies and I look at these indexes, I'm typically looking at the S&P index. Okay, if you look at my screen, there's a lot of different indexes. Look at this, 23%. Wow, looks great. 23. Look at this top one. 25. Wow, looks great. Well, they're back tested. Okay, they're back tested, brand new indexes that started a few months ago. Okay, and carriers are always doing this. They're always trying new things. There's nothing wrong with that, but you have to realize if you're doing it, you're the guinea pig. Okay, they're trying it out on you, and hopefully it works out. What I would recommend if you're going to do something like this and you're looking for market protection, you're looking for growth, then pick the S&P index or the NASDAQ or the UBS index or the PIMCO. PIMCO is a good one. It's owned by Allianz. There's some good indexes out there, but if you want just something that's tried and true and it's to the stock market, then I just say S&P 500, okay? And make sure it's the pure S&P 500, not a variation, okay? Not the S&P Mark V, completely different, okay? There's so many different, you can see NASDAQ 100 Bitcoin. This is brand new, okay? It's not the same as the NASDAQ, okay? It's not the same as Bitcoin, okay? These are brand new indexes that they are trying out, okay? Nothing wrong with that, and they might do well. But more often than not, most of the time, I just don't see a lot of these new ones do so great. So, and it's just because you can back test all you want and the market conditions change all the time. And they're not exactly the same as they were the year before. Even though they might be similar, they're just a little different. And the algorithm is a little different. And because of that, it throws everything off and it does not grow the way they illustrate. Okay. But a lot of guys will do this. They'll illustrate these huge returns. They'll say, look, you're going to get 150% of this great index. And I'm like, okay, 150% of what? Zero? Yeah, maybe it might grow that, but it probably won't. And so a lot of times people will be put in these contracts. They're stuck in them because they got a 10-year surrender charge period. And now they can't get out without a surrender charge, and they don't want to do that. And so they're stuck with these 3% returns, right? So it's a lot better to pick the right company in the beginning. Okay, and I'll just tell you, there are some companies that are known to keep their renewal rates on these caps and these participation rates for the S&P index consistent year over year. I'm not saying that they don't change. Sometimes they go a little bit lower, sometimes they go a little bit higher, but they just have a reputation of keeping them at higher rates. Those companies are American Equity, Gillico, National Life Group, Lincoln, Delaware, just to name a few. Okay, I only recommend a few of these carriers because they're the ones I'm comfortable with, because they're the ones I've watched, and they're the ones that I feel comfortable recommending to my clients based off of their history and their reputation. Okay, I represent over 70 carriers. Certain carriers are better for fixed growth, certain carriers are better for lifetime income, and certain carriers are best for cap and participation rate growth in the S&P and other indexes. Okay, and so when I'm looking at your goals, then I usually recommend ones that I feel that's going to make you the most money. So I want to make sure that when you call me back in a year or two, or if you come up to Lake Tahoe to visit me, that you're not like super mad that I sold you that annuity. I want to make sure it's a good product, right? So I want you to have as close of a return as possible to the illustrations that I'm giving you. Okay. All right. So I'm going to go in here, get off my soapbox, and actually show you something. All right. So I'm going to do Lincoln. I do like Lincoln. I'll be honest. I do like their S&P 500. All right. So let's see here. S&P 500. You got the 5-year. You could do that, but just realize if you got 3 years where it's really good and 2 years where it's really bad, and your credit interest is not so great at the end of the 5 years, you're going to wish you would have done a 1 year, because then you have more compounding periods. A point to point 1 year is just you buy it in June, then your anniversary date is in June every year. And they measure the index from June to June and give you that whatever it's capped at, or whatever the participation is. Okay. All right. So for this instance, I'm going to look at the participation rate of 55%. Okay. So let's look at this. And I like this. They're not giving you all the market, but you got to realize there are times where they cannot exercise the call options that they just purchased for $1 billion. Okay. So they cannot give all of the growth to you. So there's a cost to market protection because you're not in the market. You're getting some of the market returns via a call option. Okay. So here is worst case. Worst case, 250 does nothing because we have an extended recession and never goes up. Okay. That's worst case. I don't think that'll ever happen, but that's there. Then here's what it's done in the past. If it continues to repeat itself, it does pretty well. See, over 10 years, it'll probably grow to $592,000. Okay. It'll do better in the stock market, but at least during the bad years, you don't experience any losses whatsoever. That's really nice. There are no fees in this, so it's just a straight growth strategy. Okay, this is very popular with a lot of my clients because it works well. Now, if I go into here and I say, well, 592,000 at the end of 10 years, that looks pretty good. You can see right here, 14%, 15% on some of those good years because you're getting 55% of the market. It's a whole lot better than a cap of 10, right? Now, let's go back and we'll say, I don't want all of it in a participation, or maybe I don't want any of it, okay? So 9.1 here that you're seeing here, just so you know, that's an effective rate of return. So the average, over that 10 years, with some years not making anything and some years making a lot, the average, they're showing 9. Okay, so if we go in here, you'll notice I have 100% into the S&P 500 participation rate. You see there's these newer ones you could try out, but they're not as, look, this is only 4 years old. Okay, this is an example of an index that they're trying out. Okay. Now, if I do a cap, see, 9%. So we'll just say 100% here. Now, 100% in cap, like if you feel like, hey, we're going to have some choppy waters and we're going to have a bear market, yeah, it might be best to put it in the cap, right? Because maybe you don't get 30% returns ever again. Maybe it's only 10 to 12. Well, then that might be a better thing to do. You see, they got a fixed account here too, 4%. All right, let me go in here. See what this looks like. So the end of 10 years grows to like 498. So roughly what? 100 grand less. And that's just because you see it hits the cap many, many times, most of the time. Okay. It hits that cap and it limits your growth during those really, really good years. But if all those really good years really only hit 12% and you're averaging on the S&P like 8 to 13% and it just kind of goes back and forth and some years it doesn't make anything, then yeah, a capped strategy is going to be way better, right? Because if the market only does 10% and you're capped at 9, you get 9. A 55% participation rate, it's going to give you like what, 5.5? Okay, it's not as good, right? So you just have to kind of, and here's the other thing to remember with these, and I love this about this. It's a 1 year point to point. What does that mean? It means you can change it. You can change your allocations each year. Okay, or you can mix it up. You might put half of it in the cap and half of it in the participation rate because maybe you're not sure what it's going to do. That's a good strategy as well. Okay, and maybe you want to spread it out over the other options. You saw there was a fixed option there of 4%. You might want to just say, hey, I just want some fixed growth just because. I'll put 25 grand in there and I'm going to get 4% guaranteed on that. That's good too. So every year you can change your allocations up. No matter what, you do have the full market protection. Okay, you're not in the market, you're protected against any risk. But there is a strategy involved in how you put together your fixed indexed annuity contract. Again, we're not looking for lifetime income. If we were, we'd be talking about an income rider. Okay, but this is just straight growth and market protection. So it all depends on how you feel about the market, how you feel on the outlook. And if you want just kind of to feel it out and say, I don't really know what it's going to do. I hope it does well, and I think it will, but I still like to get, maybe if the year is so-so, maybe get a little bit more because of the cap, then maybe just do half of it in the cap and half of it in the S&P 500. And when you do it with a company like Lincoln that is known to keep their renewal rates at a pretty consistent level every year, then you know that you're not going to be stuck into something with a company that's going to lower it drastically. So that's really important. It doesn't mean they can't, but at least history shows us that it's very, very unlikely. And typically when you have a reputation like that, you like to uphold it. You like to keep it where it is so that agents like me will keep recommending it because I want to make sure that you're happy. That's really, really important to me. So this is not the highest commission option. Okay. There are other options I can sell you that will pay me 3% more. Okay. That's great. I mean, I'd love to get 3% more. They'd give me like another $7,500 in commission on this, but I don't feel confident that it's going to grow. I know it's not going to grow like this will. Okay. And so for me, I'd rather you see and I'll show you those too. Whatever, I have people reach out to me and they're like, well, what about this? What about this? And I'll say, I'll give you my opinion. And I watch all these companies. But I just want you to have a good experience. I want you to have a lot of growth. And there's a great strategy on how to use caps and participation rates. And if they're used the correct way, then you can really energize your annuity account and get more growth than maybe you normally would if you didn't have that information. So now you do. Hopefully it helps. Again, if you're looking for an annuity for yourself and you're looking for help from someone who's transparent, who's willing to share everything, then book a call with me. There's a link below this video, and there's a link on my website, johnstevenson.com, and reach out to me. I'd love to help you purchase an annuity if that's what you're looking for. If not, enjoy the video. Enjoy the other videos on my channel. I've got hundreds of them that answer lots of different questions, and I hope that they are giving you value. So I appreciate you for watching, and we'll see you next time.